Hello, this is Linda Keith, and I am following up on a webinar, 60-minute webinar on global cash flow of tax returns when you have multiple pass-through entities in the mix. Let's see. Depreciation. What do we add back? Well, the answer to that is you add back whatever hit the bottom line you started with. So in the webinar, I showed you how you could just take the bottom line and then add back interest, add back depreciation, and so forth. I had you start with taxable income, bottom of the corporate, the partnership, the S-Corp, for that matter, the Schedule C, Schedule F, and then make your adjustments to that to come up with recurring cash flow. Some lenders do use instead net income per books. It's Schedule M1, Line 1. Baker Hill does this, Moody's does this, other internal software does it. But if you start with income per books, then you do have to find any and all depreciation that's hit that number. So let's pick the people that are just doing front page bottom line, which is the easier one to do. The only depreciation you add back is front page depreciation. You don't add back the depreciation you find on M1 either on the left or the right side, and you don't add back the Section 179 depreciation that's sitting over on Schedule K. Yes, it's depreciation. Did it reduce your number? No, it didn't. Okay, don't do anything with it. And it is a pass-through, by the way. That Section 179 is going to go hit their 1040, but it's going to hit the 1040 return on Schedule E, page 2. And do you remember what I said to do about that number? Nothing. So because I don't use those numbers, Schedule E, page 2, I don't get stuck with accidentally reducing their depreciation there either. So depreciation, add back whatever has hit the number you have. Now those of you, and it was a fewer number, but if you do use income per books, then you've got to add back the depreciation from the front page, adjust it for both M1 numbers, and decide if you want to throw Section 179 in as well. Most of you who use book income for your start, you're doing it because you want to sort of do an earnings analysis, sort of an EBITDA analysis too. And the problem is that whenever you use depreciation per tax return, by definition, it's not generally accepted accounting principles type depreciation. So I personally just don't like using Section 179 depreciation anywhere in my numbers. If I'm doing earnings analysis, it's not valid. And in fact, my AgLenders frequently, what they do is if they are going to put depreciation in for an earnings purpose, they'll often replace the number that's on the tax return with some formula based on percentage of equipment or something else. In other words, if they're using it for earnings analysis, they want a relevant number. So depreciation, the main thing for us from a cash flow standpoint is we add back whatever we've allowed to hit our starting line.